Okay, it's October the 7th, 2021, and we're going to do video number 3. I had to put the date on what I'm reading to you. Okay, I want to make you aware that at the end of each session, I have an insight section. Those are things that I've learned from being a trader. They're things I'm trying to share with you. Believe me, there are 1,000 more than that, but as I think of little things, probably because of what we're doing, I will make notes there. Okay, what you're looking at is a squelched up, and the reason I say squelched up, if you know, if I use my wheel on telechart, I can shrink it out. But you can see that back here in, let's see, 2020, that's when the Dow dipped last year. That's when COVID came about. This is a chart of the Dow Jones. I'm sorry. This is a chart of the Dow Jones, okay? So these are what we call pullbacks. So let's go out, let's bring in a closer daily chart of the Dow Jones. And you can see that the Dow Jones has pulled back quite a few times in the last year. Let's go over here. If we click down on telechart and drag it to the bottom, when the little menu you see to the left is telling me that that fell 4%. That's called a Fibonacci retracement. Here, it fell roughly 4%. Here, roughly a little over 3%. And then this one here, it has fallen now about 5%. So telechart gives us the capability to be able to drag our cursor from one point when we anchor it down to another point, and the little chart that you see to the left, look at the bottom on the right hand side in the red, it'll have a percentage, and that lets you know what that Fibonacci percentage is. All right, this is what we call fingerprinting, or what I call fingerprinting. I don't know if anybody else does this, but I like to know when I'm trading a stock, if it pulls back, what is its usual pullback percentage, okay? So we're looking at the Dow, and we see that the Dow has typically over the last year pulled back 4 or 5 times to maybe a 5% pullback and then took back off, okay? This is the S&P 500. It usually mimics the Dow, so you can imagine their pullbacks are probably the same. But I do want you to notice, look at my 52-week, look at my 50-period moving average, the blue. Look at my yellow. Look at my green. And this is a Comp X, which is the NASDAQ. Okay? This is a chart of the NASDAQ. They also mimic the Dow. And you can see that they've had several pullbacks too. Here they had a 4% pullback. Here it had 3.5% pullback. Here it pulled all the way back about 6%. And here it pulled back about all the way to the right about 5%. So you can see it has roughly between 3 and 5% pullbacks every 2 or 3 weeks or 2 or 3 months. So that's something that you can know about the broader markets. But what you need to know is that over the long term, look what they do. Over the long term, and this only goes back to 2017, the Dow has been in effect in these markets since, not the NASDAQ, but the Dow, let me show that one, has been into effect ever since the early 1900s. You notice over time it goes up, okay? So, and that's why you shouldn't panic too much when you're in a position and the Dow acts up. Generally, it'll go back if you got a good stock and you got it at a good price. generally it'll go right back to where you purchased it. Okay, let's move on. Here is a chart. I want to show you something here. I drew this circle on the left and the circle on the right. Now, if you notice, this particular stock was creeping along right over in here somewhere. I'm going to put a red line kind of down the middle so you can see. It was creeping along right up in here somewhere. Okay? So the stock was creeping along right at about $40, $41 a share. Then it took off into an uptrend. Well, what we're going to call this 40, 41, we're going to call this support. So if it falls back, we expect it to fall back somewhere in that range. Oh, you need to remember this too. Support and resistance are never a one data point. They are a range. So the range for this support could be between $30 and $40. That's a range for support. Okay? Now, what I want to illustrate in this particular chart is what we mean when we say evaluate risk and reward on a chart before you purchase the stock. You'll get better and better at this as time goes on. You'll be able to see it without even doing all this. I'm going to say right here, this would have been a good buy point. If you bought it here, I'm sorry, this thing. If you bought it here, you would have made 74% on your money from April to the first of the year, pretty much. No, from April to about February. April, May, June, July, August, September, October, November, December, January, February. That's 10 months. You would have made 75% on your money in 10 months. So what that says, if you had 100 shares at $4,000, you would have made $7,500 by February. That's what it's telling you. Okay? Now that's your reward. Your risk is if you buy it here, okay, at resistance, if you buy it here. And if you notice the stock has been higher than this. Let me see. The stock has never been higher than this. So when it starts showing you signs of weakness, you want to get out. You don't want to buy there. So let's suppose a person bought it there, okay? They bought it here, and where it is right now, they would be down 20% on their money. That's called risk and reward. The higher you buy it towards resistance, the more risk there is. The lower you buy it, the less risk there is, and the more chance of a reward there is. And that's what we mean when we talk about risk and reward. Okay, now I'm going to show you a price pattern. In the very first email that I sent you, no, not the first, probably the second, because that's when we started charts. I sent you on one email about 10 or 15 chart patterns. Now, what you have to understand about chart patterns, don't ever believe anything face value. When it comes to chart patterns, never believe anything face value. Okay? So generally, when I see a pattern, I ask myself, what is the conventional wisdom of that pattern? Well, I don't believe it's going to do that, so I wait for it to do the opposite. If it doesn't, and I miss out on a trade, it's okay. There'll be more trades. I want you to write down what I just said. There'll be more trades because that's a strong market psychology. If you ever get to the point where you start feeling like you're missing trades and you start operating in that MO, you're going to be in trouble. We all miss trades. We just wait for the next one. So don't let your anxiety get you when it comes to trading. Okay? Here's what I'm going to do. I'm going to draw a triangle here. And this particular one we call an ascending triangle. And the reason we call it that, if you notice, well, a better one is over here. Actually, a better one is right here. We'll draw this one. Now, if I stretch these out a little bit, they'll look more like in a triangle. This area back here, right up in here, you notice well, I don't want to use that, but if you notice your stock went up from this period until now. We call that a flagpole. And then you see it kind of waned. And if you draw your triangle line, it takes time to see these things. We call that an ascending triangle because the stock was in a movement up before it created the triangle. The conventional wisdom of an ascending triangle is that it will break out this triangle somewhere to the upside. We don't want to believe that, okay? What I always tell myself, it's going to break out to the downside. Because remember I said you have to be a thinker of your own? What they want people to do, they give them these rules, right? And they want people to operate as if those rules are gospel, and they're not. Oftentimes, they're what we call algorithms in the system, and they're watching how many people are believing that rule because they can take their money. This is psychology that I'm sharing with you. But a few traders like myself who are well developed, we're waiting for it to break down to the downside. And then when it settles down, if it's a good company and worth our salt, we'll buy it. So that's what we do. We don't know how long it's going to go, how far it's going to go down. But what we do is we sit there and we wait until it shows us how far it wants to go down, right? And it'll base. And that's where we'll get it. Either base or price action will kind of put in a few what we call dojis, right? And that's one of the reasons I want you to learn candlestick formations. Or it might put in a morning star, or it might put in a hammer. And when we see those things, if they're not trying to pull our legs again, because they can manage those, we'll take a position. Okay? You'll have to study. I strongly advise you to study your candlestick formations first. And you will see how to draw these in time. Because you'll see them right on the chart. Even, my eyes saw it even before I drew it. So you will get there, but you have to practice. And it takes continuous engagement for this to happen. All right, so now I want to show you some things about moving averages. but I have to change my watch list so I could find a company that has a decent change in decent moving average. Okay, you see this action right here where the moving average looks like they're crossing over? This action right here. Generally, when you see that, two things are happening. Either it's ranging like that is, or it's a warning sign that something has changed. Okay? So if you're in a strong uptrend like you are here, and you start seeing this kind of thing here, then you realize something has changed and you need to take note. Okay? Now, moving averages can give you a lot of hint as to which way the stock is going. Okay? Let me show you something. Look at the moving averages on this stock. Okay? Look at the moving averages on this stock. You notice when it was in an uptrend above the 200, and then what did it do? It went into this moment of this place we call Never Never Land, where the moving averages came together and they all crossed over. And then what happened? The 8-period moving average, which is green, the yellow period moving average, which is the 21-period moving average, and the 50-period moving average started pointing down. Not only did they point down, they crossed below the 200. Not only did they cross down, they crossed below the 200. And what do we call that? We call that God. That was ugly. Okay? Now, so you have to realize that moving averages, when they're fanning out like this, over here to your left, they're beautiful. They're beautiful. That means we're in an uptrend. But when they start crossing over like this, or even looking like they want to cross over, just be cautious. Okay? Volume trend is another thing to look for. Look at our volume here. Look at this volume, how many of these strong red spikes we saw. Watch those spikes and watch the strong green spikes. Okay? Now, down at the bottom, again, is my sector and industry. I like to see this going up. That means my sector is healthy and my industry is healthy. But there are times you might have to go into Fidelity to read about the sector and industry that you're thinking about investing in, so that you can find out if there's any stagnation in the near future or something that might throw you off. Okay? Okay, this brings to an end our third video. I want to say I really enjoy doing this, and it's going to be so much easier for me to share this knowledge with people because I won't have to spend 3 and 4 hours a night talking to somebody on the phone and on the computer. So I'll just share this with people. But one thing I want to caution you about: never take this skill for granted. This is not a skill you can just hear about, read a few things, and do. It takes time to develop into a good trader. And in order to do that, you have to do the things that I'm sharing with you over and over and over and over and over and over. In other words, you have to repeat this. These are the indicators that I use. I can show you in the system there are thousands of indicators, okay? Add a plot. Look at all the indicators that are out there. For everything, these are indicators. But I don't use all those. And the reason I don't is because I believe, and it's worked out for me, and I know it's true, that if you follow price with your moving averages and your volume, and understand whether or not your sector and industry is healthy, you'll do better than most people. The one thing you don't want to do is crowd your mind with too much information. Keep it simple. Keep it simple. Keep it simple. And as you begin to use the things I'm sharing with you and they're working out for you and you know they work, then move on and try something else if that's what you want to do. Okay? May the force of investments be with you.